For the past 2 years, the Federal Reserve has been tightening policy, but the financial system had a $2.5 trillion shock absorber. As of today, that shock absorber is gone, and the real impact is about to begin. So, from my seat, this is the most important signal in markets right now, and almost no one is paying attention. Today we're going to break down 3 things. First, what just happened in the Fed's pumping and why this buffer vanished. Second, how the US Treasury has now put the Fed in a checkmate position. And third, what this means for the dollar, for long-term bonds, and for gold. Let's get into it. So what was this shock absorber? It was the Federal Reserve Overnight Reverse Repo Facility, or RRP. Think of it as a giant parking lot for cash. So money market funds had trillions in excess cash and they park it in the Fed overnight for a safe yield. At its peak, this facility had over $2.5 trillion. But as of today, it's effectively empty, down to just zero. So where did all that money go? The US Treasury needed to fund its massive deficits, so it started issuing a flood of high-yielding T-bills. Money funds, seeing a better return, pulled their cash out of the RRP and bought those T-bills. Now, here is the critical point. While the RRP had a balance, the Fed's quantitative tightening, or QT, was draining liquidity from this non-bank parking lot. It didn't hurt the core banking system, but now that buffer is gone, and the engine has ceased. To understand why this matters, you have to throw out the old textbooks. So from my seat on the trading desk, you need a different framework. And the core thesis here is simple. We have entered an era of fiscal dominance. In plain English, that means that the government's need to borrow money is now so large that it dictates the central bank's policy. The Fed is no longer independent. It's a backstop for the Treasury, so the tail is waging the dog. The math is brutal. The US is running deficits over 7% of GDP during an economic expansion, and interest payments on the debt are exploding. And that means the government is in a debt trap. It cannot raise taxes enough to pay its bills without causing a recession. And this has echoes of the 1940s when the Fed was forced to cap bond yields to finance the war effort. We are in a similar undeclared financial war today. The Fed's public mandate is jobs and inflation. Its real, unstated mandate is ensuring the Treasury market doesn't break. So what's the first sign of a stress you're watching for in the funding markets? Let me know in the comments below. And that brings us to the checkmate. With the RRP buffer gone, any new Treasury debt and any continued QT must be paid for with cash pulled directly from commercial bank reserves. Let me put this another way. The Treasury was drinking from a rain barrel. Now its hose is plugged directly into the town's water main. The pressure is starting to drop for everyone. So we are already seeing the cracks. The Fed's emergency lending window, or the standing repo facility, just saw an unexpected spike in usage. This is a alarm that funding markets are getting tight. So this is a direct parallel to the repo crisis of September 2019, which forced the Federal Reserve to end QT and start printing again. The outcome now is binary. Either the Treasury market collapses under the weight of issuance, or the Fed prints the money to buy the debt. There is no third option. Now, to be fair, the view from Wall Street is very different. They'll tell you that this is all part of a healthy soft landing. Goldman Sachs, for example, expects strong GDP growth of 2.5% next year. They see recession fears fading and inflation falling back to a target. Others argue that the RRP drain is just a normal portfolio shift, not a sign of stress. So they'll say bank reserves are still ample at over $2 trillion, but this view mistakes cyclical data for structural reality. It's looking in the rearview mirror. The problem isn't last quarter's GDP, it's the forward-looking math of a sovereign balance sheet. And the idea of ample reserves is a guess. So the 2019 crisis happened when everyone thought that reserves were ample. The system is now mechanically more fragile. So what is the endgame here? The US government cannot afford high interest rates. It would be insolvent. As Jeffrey Gundlach has noted, there is an anti-dollar theme running through markets right now. The dollar must become the release valve, and the Fed will be forced to restart QE to fund the Treasury. This isn't a forecast, it's a mathematical certainty, and the rest of the world sees this coming. Central banks, led by the BRICS nations, are dumping treasuries and buying physical gold at a record pace. They're preparing for a world where gold is remonetized as a neutral reserve asset. For key assets, this implies the dollar faces a structural devaluation, long-term bonds will be destroyed in real inflation-adjusted terms. Stocks may rise in dollar terms from the liquidity, but they face extreme volatility, and gold is the primary beneficiary here. Is the insurance policy against this entire endgame. The shock absorber is gone, brace for impact. This is the kind of analysis you won't get from the mainstream. If you want to stay ahead of the curve, make sure you subscribe and turn notifications on. Thanks for watching.